Hi, and welcome to the November Buy-to-Let Mortgage Market Update. My name is Richard Pennell from Mortgage Home, and we are your buy-to-let mortgage experts. Now, I want to start by giving a thank you and an apology all in one sentence. The thank you is for those people that got in touch with me directly, with the office, to say, is Richard still alive? Have I missed the October update? What is going on? And this is the hands up and apology bit, because I didn't do one. There's your answer. I was away for an extended period of time. For those that know me reasonably well, I'm quite into my triathlons, and I had two triathlons internationally, and stayed out there for both of them. So I was for pretty much a full month of October I was away, and it was just too complex to try and do one whilst out on the road. So normal services resumed. Here we go. What have we got in line for you this month? Well, of course, what's happening with rates? It's all going on now, isn't it? Really good news with the Bank of England last week. By the way, I'm recording this on the 12th of November. So last Thursday, the Bank of England announced a rate cut. So that's great news. What does that mean in terms of more rate cuts, in terms of mortgages? That should interest everybody. So for that piece of education, please spend 5 minutes on that piece of content. Now, of course, this for the next piece, the budget. This was on the 30th of October. So, you know, there's that anticipation, wasn't there, from Rachel Reeve and Keir Starmer for what feels like forever, trying to scare us to death about the budget. So what does that mean for landlords? I've given a quick summary, and that will have a ripple effect on every single landlord. So please, if you still feel you're not fully educated on what the budget means for landlords, do spend 5 minutes on educating yourself on that. Now, discounted purchases. We get inquiries and applications, if not every day, every week from landlords. Now, who doesn't try and get a discount? Nearly all of us. But here's the thing. Did you know that so many lenders really, really passionately do not like big discounts on purchases? So if you're actively buying properties into 2025 and are looking for big discounts, then please educate yourself to understand why on earth lenders would be bothered whether you get a discount or not. And more importantly than that, how do we sidestep it? Finally, quitting smoking. Well, look, I came across a statistic only in the last few days that said that there's 6 million UK people still smoking. However, the number is decreasing every year. So it got me thinking that how many of those people that have quit smoking, and by the way, it's about 500,000 a year, would actually link that to their life insurance policy, because I bet they have not joined the dots. And more importantly than that, there is thousands and thousands of pounds of premiums that they could be saving if they could understand that a little bit more. So please, if I'm talking to you as a person that is about to quit, has quit, or knows someone that's quit, then please just spend 5 minutes on that little section, because it could save you thousands. In this piece, I want to talk about the market. Now it's all kicking off, isn't it? For the second time since the pandemic, the Bank of England have actually cut rates. So we're now down at we're under 5, we're at 4.75%. Amazing. So are we on a bit of a roll? Well, I'll talk about that in a minute. Now, as well as that, inflation. I always link inflation and have a little comment about it, as well as the Bank of England, because they're joined at the hip. And inflation, wow, we're down at 1.7%. Who forecasted that? The Bank of England said, come on, we're going to get it to 2%. It wasn't long ago, was it? We're at double figures. And not only have they hit the 2%, but we've actually overshot now. We're down at 1.7. So our ducks are lining up. Surely mortgage rates are going to be tumbling, Richard. Come on, tell us that mortgage rates are coming down. Well, here's the thing. They really are stagnating. We're not seeing mortgage rates drop in the same way that the Bank of England has. So here's the explanation. Now, in recent times, I'm talking the last 15 years, banks have moved away from that direct connection with the Bank of England, and they raise a lot more finance that they then use to convert into mortgages from each other. They sell and loan money out between each other, banks to banks and institutions to other banks. And they don't use the Bank of England rate as the mechanism to say, well, how much are you going to charge me? If Barclays is going to lend £500 million to the Halifax, what interest rate will Barclays charge to Halifax? And they use something called a swap rate. And that reflects a wider range of issues and challenges in the UK economy than the base rate. And therefore, swap rates have been going up. Now, before we all panic, this is marginal. There's nothing dramatic going on. In fact, it's almost flat. But overall, and I'm speaking generically, mortgage rates have been going up in the last week or two, 0.1, 0.2. Nothing to get a flap about. And it will calm down. Why has it been happening? Well, it's all around the budget. You know, good old Rachel Reeves, who's trying to raise £40 billion from this particular budget. So it's going to hurt. It's not something that the markets, they know it's got to happen, but not particularly happy. It doesn't really impact well from a market perspective. And so it's been reflected in slightly higher rates. So that's why right now we're just seeing a slight increase on the mortgage rate. However, far more important than that is if I get my crystal ball out and say, well, what's going to happen? Not only, we're almost at the end of the year. We've got one more meeting, by the way, with the Bank of England on the 18th of December. And it might be that rates drop again. But, okay, we might get an early Christmas present there. More importantly, let's look into 2025 now. Because I would expect, notwithstanding, can I say Trump? Let's just park him for a second, shall we? Because who the hell knows what he's going to do? But assuming that we don't have that negative ripple effect from over the pond, then I would expect the Bank of England to drop rates by anything around 1.5% next year. Now, of course, if we're getting repeated Bank of England rate cuts, then yes, absolutely, we'll see that follow through in terms of mortgage rate drop. So I would expect a 1.5% drop on mortgage rates by the time we get to the back end of next year. But we're still a year away from that big cuts. So in terms of a takeaway message, if anyone's sat on their hands on SVR, what on earth are you doing? Do not hang around on SVR expecting some fantastic mortgage giveaway. It's not going to happen. So please, please, please make some decisions. And if your fixed rate's coming to an end by the end of the year, by the way, 1.6 million fixed rates come to an end in 2024. So please make your decision now. The only thing I would counsel you on is what deal you go for, because lenders are really simplifying the choices for us, which I don't think is a good thing, by the way. However, that's another topic. 90% of all products out there are fixed rates. And I did a piece back in September on fixed rates versus trackers. So, but by all means, look back on that if you want to know more about the tracker side of things. But with fixed rates, it tends to be a 5-year or a 2-year. Yes, there's 3-year rates, but not many around. Yes, there's 10-year rates, but not many around. The bulk of the deals on offer are either 2 or 5. So, I'm personally, if I put my landlord hat, I am leaning to the 2-year deal, because I think in 2 years' time, towards mid-late 2026, I see rates have dropped by 2% and more, and therefore I can get some cracking rates in 2 years' time. If I look into a 5-year fixed right now, I think in hindsight, when I look back at that 5-year fixed rate, I'll think it's quite mediocre. Look, it's personal choice. Chat to your broker about all the risks of 2 versus 5, or indeed whether a tracker might suit you before you make that decision. In this piece, I want to talk about the budget, Labour's first budget. Oh, my word. It feels like it's been coming forever. It's been, and they built it up to be this big fright night. Rachel Reeves and Keir Starmer have been trying to scare us to death, and rightly so. We knew it was going to hurt, and they've been saying and building that expectation up until eventually on the 30th of October, Rachel Reeves actually disclosed how painful it was going to be. And of course, as a landlord, we're going, okay, £40 billion worth of tax that they've got to find. How much of that burden is going to get picked up by landlords? Because do you know what? We are so used to be taking a kick in since 2016. It feels like every single year, let's give landlords yet another kick in and see how much more money we can squeeze out of them, how much pain they're prepared to take. And so we're almost expecting landlords to be hit as a soft target yet again. Now, I don't know about you, and by all means, put some comments down below the video. I'd be really interested in your overall perception of it. Mine, again, if I put my landlord hat on, I feel like we've got away with it. Not entirely, of course. We're not going to get away scot free. There's some pain, and you can see on my bullet points. Second home stamp duty is the biggest one, which I'll come to in a second. But that aside, I feel that actually we've got away fairly lightly. And if you think about that £40 billion as a cake, how much of the landlords had to contribute to that 40 billion? It's 1 to 2% of a £40 billion invoice. So, relatively speaking, I think it could have been a lot worse. I think that's my summation of it. But let's get into it. And what I've done, because I don't think we've been hit that hard, I've expanded it on in terms of what also are the Labour government's major manifesto promises that impact on landlords. So I've sort of blended two things here. And so we're going to start with renters reform. Oh my God. Does this feel like it's been around forever? It feels to me like it should already be enacted. It's already, the rules have already changed, and they haven't. Look, the Tories were going to run with it and would have run with it if they hadn't been kicked out of town. But Angela Rayner, she's picked that ball up, hasn't she? And she has said, right, I'm going to get it over the line. They debated it in Parliament again in the last week or so. Doesn't seem like it's not seen as contentious from a House of Commons point. God, I nearly forgot. House of Commons point of view. So it looks like it'll go through fairly smoothly. So for those of you that have been living under a stone, what does it mean? Or a quick reminder. Look, right now, if we want to evict a tenant within certain parameters, i.e. they're not tied into a tenancy agreement, if it's come to an end, you can give them 2 months' notice. You do not need to give an explanation. The tenants do not have to be at fault, but the no fault rule is being removed. So as a landlord, that dilutes some of our control, but the main controls and the main reasons that we're going to kick a tenant out is not for no reason whatsoever. Yes, I get that sometimes there are reasons that you want to try and move a tenant on, but the big chunky reasons, i.e. rent arrears, their antisocial behavior, they're not looking after the property. Those major issues are still there. If you want to sell the property, you can still have the tenant evicted. So, those powers as a landlord are still intact, but the no fault is going. Let's get used to it. Now, look at the next one. EPC ratings. Yes, they are back. Now, the Tories tried to push this through, and I think eventually they got cold feet. They listened to the whispers of the lobbyists, and they'd kicked it into the long grass. But Labour, again, they've picked up and they're going to say, no, we're going to push this one through. It's a real challenge for them. I'm going to explain in a minute why I think the Tories dropped it. Because, look, what is this new regime, this new ruling policy that Labour are trying to bring in? Well, we all know about EPC ratings. They've been around long enough. But the rule is that by 2030, now the Tories wanted it, a soft line in the sand was 2025, which was because of its imminence, which I think is why they dumped it, and then a hard line in the sand at 2028. So Labour, they've given us another 2 years. However, this is the size of the problem. 4.5 million rental properties right now in 2024 do not meet those targets. So they're at D or lower. That's a massive, massive effort on landlords' parts to collectively drag our Victorian terrace houses into the 21st century and make them energy efficient. It's a massive task. And so what are we going to do about it as landlords? Look, it's 6 years away. You're shouting to me, Richard, I've got bigger fish to fry. I've got bigger things to worry about. And I sort of get it, but I want to challenge you on this a little bit, because lenders are incentivizing you as landlords to drag that rating up to a C because they'll offer you better deals. So if for no other reason than they're dangling a little bit of a carrot, and I'd hope that carrot gets bigger because there are savings to be had, but I think they could be bigger from lenders. And I guess as time goes on, my view is that the government may lean on the lenders to offer bigger incentives if landlords are not seen to be heading in that direction. But here's the thing. Someone far cleverer than I did the maths on what it would cost to drag an average rental property from a D rating to a C. And the figure was over £9,000. So I totally get that as a landlord, you're thinking, 9,000 quid, I'm going to sell up. Because if you've got a mortgage on that property, then your profits, I would say, let's say for conversation's sake, your profits are £2,000 a year. That's 4.5 years worth of profits. So in very simple terms, why on earth would you may as well sell up now and move on and get a different property or do whatever. But here's the thing. I want to challenge you. I want you to think, not in terms of this £9,000 as an expense, but as an investment. Now, bear with me. You see it as an investment for a number of reasons. One, because it will increase the value of your asset. Two, I genuinely believe that you will be able to put the rent up. Three, as I said earlier, mortgage lenders will offer you cheaper deals. So all in all, there's lots of ways that can incentivize you to consider it as an investment. The final thing is that lenders are also offering you additional further advances on your mortgage that you can only access, one, at preferential rates, and two, if you can prove it's for energy efficiency purposes, i.e. to bring the rating up. So the reason I say see it as an investment is not from just a fanciful, let's just rebudget point of view, but from, I'm an accountant. So if you see it from an accounting perspective and see it as a capital spend, not a revenue spend, then if you're spending 9,000 quid and you've got that property for the next 20 years, then that's about £40 a month that it's costing you because you've added to your mortgage. And as I said, it's 40 quid a month. But if you can actually put your rents up a little bit more and a little bit quicker, and you can get cheaper mortgage interest rates, that offsets the 40 quid. Then actually, is it 30 quid? Is it 20 quid a month? And all of a sudden, you're seeing the numbers differently, and it might see your decision about whether you invest in your assets or not. So I'm hoping that's going to give you just a different perspective on EPCs. Right, here's the one that really sticks in everyone's thought. Second home stamp duty. I get the initial reaction as it was for me when I saw it. It was a little bit of a shock, I got to say, from 3% to 5% additional tax. So that's a big extra chunk of money to pay over to HMRC, and I get that. It is, if I'm playing devil's advocate, it brings us in line with Wales and Scotland. Wales are about 4%, Scotland around 6%. So if we're now going to be paying 5%, we're in line with that. Does that make it more palatable? No, it doesn't. I totally agree with you on that point. However, let's just rewind to 2016. Back in 2016, there was a time at probably the beginning of that year, there was no additional stamp duty whatsoever. And all of a sudden, out of left field came this new 3% additional tax. And yes, we threw our hands in the air. Yes, we bellyached about it down the pub. But you know what? We adapted. We got on with it. We got used to it. We started negotiating stronger discounts to build it in. We did our pricing a bit more keener. And we said, does it still work if there's a higher cost? And we made our decisions on that. And you know what? I think us resilient landlords will do it exactly the same. Now it's gone to 5%. Now, I also want to just give you some headlines of how you might be able to sidestep this 5% all in all. So you might want to get your pen and paper out and jot these down. I'm not going to go into any detail whatsoever, so you'll have to Google it, get your education elsewhere on these other ways, mechanisms, strategies for making money out of property that will sidestep the 5% stamp duty. So this isn't exhaustive, but it gives you a flavor. Rent to rent. Have you heard of it? It's been around for quite a few years now. So rather than purchasing the property and incurring that stamp duty, you rent the property off someone else, come to an agreement, and then you make your money that way. Commercial to resi, it's been growing in popularity for a few years now. And certainly with permitted development rights, where councils are allowing you to get hold of a commercial property and convert it to resi with less restrictions, and that doesn't come with the same stamp duty bill. Excuse me. Uninhabitable properties. Did you know that they don't come with the same stamp duty bill? So if you're buying a property and it is classed as uninhabitable, look up what that means separately to this. But if you can demonstrate that it is, then it doesn't come with that same stamp duty bill. Now, we're getting inquiries, and I suspect they might get more after this 5% stamp duty is coming, where if you are buying properties from another landlord, let's say, and in the past you bought them as an individual, you bought the actual property, have you considered, or would the landlord consider, selling the actual limited company that the property is sat in? So you're buying the company, not the property, because guess what? From a stamp duty point of view, the property is not being sold or purchased. It's the shares that are changing hands. So if look, it's a complex subject. And by the way, if you look back on some of I didn't check when I did it, but a few months ago, earlier this year, I did an educational topic on buying limited companies that hold properties rather than the properties themselves. So if you want to educate yourself a bit more, just look back on previous updates, or email me if you want me to ping it out, and I can send you that particular piece of content. Look, back to the script. So if you buy the limited company, not the property, that does sidestep the stamp duty costs. So I think over time we'll see more buyers looking at that. And I know, and therefore I'll see. It is complex, and lenders are a little hesitant out there, but I could see lenders seeing this as getting more commonplace as time goes on. So that's another way around it. Now, lease purchase options. Again, it's quite a bit of a dark art and a little bit more complex, using option agreements. But there's plenty of property education companies out there offering one-day courses on lease purchase options. So if you're interested in that, look it up, Google it, or again, ask me for recommendations. And I can point you to some recommended fantastic educators who will talk to you about lease purchase options. But again, that sidesteps the stamp duty, and there's other benefits as well. And finally, what about flips? There's always been landlords that actually don't want to hold properties. They want their focus and their passion is actually to develop properties, to renovate them, and then take the money out, take the profit, and move on to the next one. Well, that's from a HMRC point of view, you're trading in properties, you're not investing, and therefore it doesn't come under the same taxes and stamp duty that you and I have if we're holding and returning properties. Look, it's not exhaustive. There's a few examples. I hope it's given you some cause for encouragement and not to be totally disheartened about that second home stamp duty. Finally, I put national insurance on here, only literally just to say, well, if landlords are not picking up this £40 billion tax bill, who is footing the bill? Well, actually, national insurance, that hike in NI contributions accounts for something like 3/4 of that £40 billion. So it's about 30 billion is being raised by increasing national insurance. So if you are a landlord that happens to be that one, that in that 1% bracket that actually got such a large property related business that you employ staff, then look, you are getting more of a kick in. It is going to hurt you more than the rest of the landlords that probably don't employ staff. So very unlucky, but that's the way it is, and that hopefully covers that off. Now, if anyone wants to have a chat with the team about anything I've discussed here, about some of those strategies, because a lot of those strategies I've talked about still require finance. Commercial to resi, the flips, buy-in, SPVs, for example, all those still require a different form of mortgage finance, which we do. And if you don't have a fantastic broker that you rely on, please just book some time in. There's a link at the end of this piece, and have a chat with the team about how we could put the finance in place for your next project. In this piece, I want to talk about buying at discount. We get inquiries and applications, if not every day, every week, about landlords wanting to buy at discount. But here's the thing: lenders have a real issue where there is a significant discount that you have managed to negotiate. That sounds bizarre, doesn't it? Because on the surface, you would be forgiven for thinking that if you had a property that all day long was worth £100,000, you've managed to negotiate £20,000 of that price. So you're buying it for £80,000. You want a 75% mortgage on that lower purchase price of £80,000, which is what lenders always do. They'll ignore the market value. So they're actually going to give you a £60,000 mortgage on your £80,000 purchase. So if you think about it, they're giving you £60,000 on something that has a value of 100. That's 60% loan to value. So that's lower risk to the lender. And guess what? Not only that, the lender's saying, well, hold on, the purchase price is 80,000. You want to borrow 60. That's 75% loan to value. So I'm going to only offer you a 75% loan to value product. So let's put our lender hat on. Hold on a minute. Lender, you've got to actually, your risk is at 60% because the value is 100,000, but you're charging me 75%. And Richard's telling me you're reluctant to do them. What on earth's going on? Doesn't make sense, does it? So if you are looking to purchase heavily discounted properties, if that's your strategy, or you just stumble across one in 2025, you really, really need to educate yourself to understand why on earth would lenders get a little anxious and do a lot of due diligence, or worse, there's lots and lots of lenders that say, no, we will not approve a case where the discount is in excess of, I would say, 10%. It doesn't make sense. So stay tuned for this. I'll explain. So first of all, to answer that question, you've got to understand why would a seller sell a house that's worth 100,000 for 80,000? Why on earth do they do that? Well, look, there's actually, if you actually just take a little time out, there's loads and loads of reasons why vendors are motivated to sell at a significant discount. It's not the topic of conversation today, but a little flavor. What about divorce? What about death in the family and inheritance? What about people moving out of the area because they want to go to a different geographical area to get little Johnny in a certain school? And so they've got to move by a certain deadline to be able to apply because you've got to be living in that area, that catchment area. What if you're emigrating? What if you've got financial issues? What if you're moving into a care home? What if you're moving jobs? And again, you've got to sell the house. What if you've got a bigger family and you really have desperate to get into that bigger property and actually the house of your dreams has just come up? There might be lots and lots of reasons why a seller is motivated. But here's the challenge from a lender's point of view. There's a couple of other reasons. In fact, there's probably more, but I'm going to give you two from a lender's point of view that makes them really, really nervous. The first one is vulnerable sellers. So there's an actual definition of this from a mortgage perspective, and it's elderly people. It's people that have a foreign language, therefore don't understand English. It's people who have got a mental health issue. And so what if you are an unscrupulous landlord and you've taken advantage of this vulnerable seller and you've convinced them that actually £80,000 is what it's worth, and actually you're doing them a favor, and they should be pleased to sell you at that price? Can you imagine, again, stick your lender hat on for a second, the bad publicity, that PR, when all that unravels further down the line and the press get hold of it, because the lender will be tarred with that brush if they're seen to be complicit with a vulnerable person that's been taken advantage of by a landlord, and the lender has facilitated that landlord in buying that property at such a cheap value. So there's one reason. Another one is about creditors. So, and I've seen it, if people are being chased hounded by creditors, they've been threatened with court, they've been threatened with bankruptcy, then I see people get rid of property as soon as they can. And they change it for something that is really, really visible, an asset that is so tangible and visible and on the land registry, and they liquidate it so they can put it into cash so they can hide it. But down the line, if that creditor finds out that that's what the individual has done, they can go to the courts and they can get that whole process reversed. So a lender is really concerned that if someone might be selling at a significant discount for that reason. And again, if the courts do back the creditors and it all gets reversed, it's really, really messy for the lender. It's expensive for the lender, and they've got to reverse everything that's gone on. Therefore, there is a big, sizable chunk of lenders that when they see that it's at discount, and I know you're saying, well, how would they know? But we'll come to that in a second. Then they will decline the case. So how would they know? Because if you don't highlight it on an application form, well, the surveyors are going to pick it up. If I stick with that example of an £80,000 house and they know it's worth 100k all day, the surveyors will alert the underwriters and the bank. And not only does it get declined, but you've wasted time, you've wasted energy, you've wasted money. So here's the takeaway message. Do I say ignore them and avoid them? Not at all. No. If that is your strategy, if you are trying to find heavily discounted, absolutely, you go 100% looking for them all day long. But what you must do is talk to your broker. Be transparent with your broker. Explain the situation. How have you come across that discount? Is it because the seller is motivated, or actually is the property in a real state of disrepair? Is there some structural issues with it, so there's not many buyers? Don't worry about the reasons, but give us the full chapter and verse. As a broker, you should be have such a relationship with your broker that you could have that conversation. The broker should be asking these sorts of questions. So again, if that's your strategy, if you're coming across those right now or likely to next year, then at the end of this piece, there's a link. Click on it. Have a chat with the team to understand about the discounts a little more. If you're having some early conversations with a potential vendor and there's likely to be a big discount, talk to us, because it influences the research you do. It influences the lenders we can talk to, and ultimately the rates that you are able to get. The sooner we can give you that information, that will maybe inform what negotiations. Maybe you want an even bigger discount if the lenders that you're offering are reduced, and maybe you're paying a slightly higher interest rate. And by the way, just to finalize on that, this is only at the point of purchase. This is the bizarre stuff, that when you come to refinance it, let's say you do a 2-year deal, in 2 years' time, you can forget everything I've just said about the wariness of the lender. In 2 years' time, you'll be refinancing it at its market value. And by the way, there's lots of ways to refinance at market value a lot sooner, but that's a whole new topic. Again, I've talked about it in the past. I might do another piece on it soon about how if you've got that £20,000 or 25% discount, how do you get your hands on that sooner than later? It's a bit more complicated topic, which I will cover off another time. But I really hope that's been of use. And like I say, click on the link below if you want to have a chat with the team about that any further. In this piece, I want to talk about you guys that may have stopped smoking recently. You're thinking of quitting smoking, or perhaps you've got some close family or friends that have recently stopped smoking and told you about it. Why? Because look at that strapline under the heading. Because you could save thousands, maybe tens of thousands on your life premiums if you've quit smoking. Now, why am I putting this topic on here? Because in the last week or so, I saw a headline that said UK has 6 million smokers. Now, that sounds horrendous, but the trend, as we probably would expect, is down. The number of smokers is getting lower and lower every year. And roughly every 12 months, 500,000 UK adults quit smoking for good. 500,000. So if you think of that over 10 or 20 years, the number of people in the UK that are ex-smokers is this growing part of the population. So it had me thinking, how many of those ex-smokers will have life insurance? 20%, 30%, 50%? And how many of those would have joined the dots to say, hold on a minute, I'm an ex-smoker. Surely I can now go to my insurance company and get my life insurance premiums adjusted down. I don't think anyone will join those dots and make that connection, which is why I'm doing this educational piece today to get you guys informed so you could save that money and have it back in your pocket. Now, here's a few things you need to think about. So if this is you, you might want to make some notes on this. You have to have stopped smoking. Now, and you've got to have stopped for 12 months. So there's the challenge. You can't be a occasional smoker. If you put that on the application form, then from an insurer's point of view, you are a smoker. It's really black and white. You can't even be on vapes or patches. They'll ask you the question and you tick, yes, I have patches, then you are still a smoker, still nicotine in your body. So it's a very simple rule that the insurer has. You have to have quit for 12 months. And I know I'm ahead of you because your next question is, how on earth would they know if you quit smoking? And the answer is they don't. There is a level of trust. Now, the insurer is at liberty to say, oh, you're an ex-smoker. You've quit 12 months ago. We're going to do a test, a simple test on you, maybe a breath test, maybe a blood test, and we will check that way. Now, the other thing that will happen, and certainly this would be at the point of claim, is that they're going to check with your GP. So let's say you are an ex-smoker, you genuinely quit for a year, happy days, and you've applied and got the discounts. I'm going to talk about the discounts in a second. And then later down the line, you do pass away, there is a claim, the insurer gets your GP notes. Your GP notes, what if it still says you're a smoker? At best, there's a real issue here. And at worst, they're not going to trust the claim that you've put in. So I urge you, one thing you should be doing straight away as a point of action, if you have quit smoking and it's been, a good chunk of time, you're not going to go back to those old habits, contact your GP, get your notes updated. Now, let's get back to the savings because these could be huge. Now, if you came to me today as a sort of 20, 30-year-old and you've got to keep it simple, you're fit and healthy, no other issues, you're a non-smoker, let's say your premium's 30 quid. If you say, oh, sorry, Richard, forgot to tell you, I am a smoker, I now tick the box of that, your quote goes from 30 to 45, 50 quid. It'll go up by 50%. Or more. As you get older, you get into your 40s and your 50s, then that differential gets even higher. It's something with 30 quid, you're probably going to be starting, if you're 40 or 50, it might be 40 or 50 quid as a non-smoker. And as a smoker, it could easily double to £100 a month or even a little bit more. So as horrendous as that is, what I'm really trying to bang the drum on today is the flip side of that coin. Because if you're coming the other way as a non-smoker now, then you've got those savings. You're coming back down. Let's say you were paying £100 a month or more. Now you're back down to potentially being offered premiums of 50 quid or whatever. So you've got those savings potentially back in your pocket. And the great thing about life insurance is that you've probably got it for another 10, 20 years. So if you can be saving, I don't know, £40 a month, well, if you've got 20 years left on your policy, that's almost £10,000 worth of savings. So look, this is not insignificant money. So please, if you are thinking of quitting smoking, make a note to talk to us about life insurance when you're heading towards a year. If it has been a year, then please click on the link below. Have a chat with us. Let's look into a bit more. Let's get you some certainty that you can get these cheaper premiums. And if we can give you that certainty, then you can be cancelling, of course, your old policy. Or finally, what a gift to be able to say to your friends or family about these massive savings. So if you know anyone that has quit, please have a chat with them, tap them on the shoulder. And if they don't know how to deal with it, just send them our way. They don't have to be clients of ours already, and we can really point them in the right direction and get that money back in their pocket. So click on the link below if you think that resonates with you. To finish off, this is our contact details. So if anyone wants to have a chat about anything I've been discussing today, or indeed any other finance related topic of any type of mortgages, I focus on landlords, but anything residential, first time buyers, bridging, development, commercial, anything that's secured against bricks and mortar, we are the local experts. Please have a chat with us, click on the link, or give the office a call, and we'd be delighted for that. Other than that, thank you so much for listening, and I'll see you on the December update.